Appreciate the opportunity to deliver this talk for this alumni event. It's always a pleasure to reconnect with the alma mater. Um, so before I begin, just very quickly, I've been at BlackRock for 15 years, and through that time, I've kind of worked in this field of active management, and that's what I'll be sharing with you all today. A little bit about BlackRock. For those of you who don't know, BlackRock is the world's largest asset manager, managing around $9.4 trillion. BlackRock provides comprehensive investment solutions that cover all asset classes, from equities, fixed income to alternatives that includes private equity, real estate, commodities, and many others. And at BlackRock, I head the platform engineering team for Alphagen Technology. So we'll hear about this Alphagen, what that means during the course of this talk. Now, before I dive into the subject, I just want to relate a short story. And I think that's kind of connects me to Professor Ganesh. Um, so during my PGP program, we had a module called experiential learning. The intention of this module was to expose participants to real world business problems and get an opportunity to apply what we learn during the program in helping solve those problems. We were assigned in teams of 2 to 3 to specific organizations in Indore, and we would once a week would go visit the organizations and work on various projects. So I, along with another participant, Sriram, were assigned to Sanghi Motors. Sanghi Motors, among other things, they had a Tata Motor dealership. And Professor Gane, I don't know if you recall, you were my advisor for that project. And again, one of the most memorable learnings from my PGP program came from this experience. Our project was to build a model that could help Sanghi Motors predict the sales of various models of commercial vehicles. And as part of this project, we would visit various facilities that Sanghi Motor had. And at one time, we went to visit their IT department. And there we saw a very expensive IBM server, and it was literally collecting dust. It was absolutely covered in dust. So we asked about this, like, why is this server, like what's happening? Why aren't you using it? And basically what we learned was that the organization made quite a lot of investment in technology and hardware, but they failed to back it up and provide enough investment in the human capital. And that whole investment in the servers and the technology hardware just was waste. I see parallels of that in today's world. There's hype around AI and ML and how it will replace humans. That's completely a whole other topic. But what I would like to stress on saying is that the success will be seen where humans, the power of humans and machine is put together. And this is sort of the premise of my talk today, how I'm going to show what we at BlackRock are doing in terms of systematic investment, and how we're putting that power of human and machine together. Okay, so let's dive into the topic now. I'll go pretty high level. I'll just kind of set some background so people who are not familiar with some of these terms, they'll get a chance to learn about it, and it's not all Greek to them. So let's first talk about what's investment management. What does it mean? So investment management is about devising and executing a strategy to manage the financial assets for a client as per the client's mandate. So clients would be, in case of BlackRock, mostly happen to be institutions like pension funds and insurance companies and sovereign wealth funds and the like. So these clients have a certain amount of investment that they want to put into the financial market. So BlackRock helps them manage those investments. There are two basic styles of investment management. Let me jump into a presentation so I can explain with some slides. Give me a second. Are you able to see my screen?
Yeah, yes, Manvendra.
Okay.
Okay.
All right. All right. So investment management. So is what I was explaining when you want to invest in financial markets. There are two basic forms of styles of investment management: passive and active. In the passive style, you're trying to track a benchmark. This benchmark might be something like S&P 500 or like various other financial indices. And the focus is on relative returns to the benchmark. You're not trying to exceed or lag the benchmark. You're trying to just match the benchmark. And these are generally lower cost to the investor. The management fee associated with these kind of investment product is lower. And here again, the basic driving factor is that there's the assumption that markets are efficient. You can't really beat the markets. So you just want to match the markets when you're investing passively. On the other hand, we have active investment where you're trying to beat or exceed the benchmark returns. And it, of course, comes at a higher cost to the investor. And it seeks to exploit inefficiencies. So there are inefficiencies in different pockets of the market, and active investment is trying to extract those inefficiencies and generate market beating returns from those inefficiencies. So having looked at that, how do you do active investment management? There are again two basic styles that are available today. One is the first one is fundamental, which is the more traditional investing, where analysts have do an in-depth analysis of companies' business, of their cash flows, of the management team, of the market opportunity. They come up with a viewpoint of how that company is going to perform, and they make their investment decisions accordingly. This is the more common form of investment management. Then on the other hand, we have what is called a systematic investment management. It's also sometimes known as scientific or quantitative investment management. This is based on using data and models to evaluate an asset's value. Here, you're able to cover a broad universe of assets, and you're trying to remove the bias and emotion that goes along with human decision making. So you want to rely on data and models to remove that emotion in the decision making. So this is where I was talking about earlier. The human and machine come together to make those decisions. So we'll be diving a bit into this process and understand what that means. So let's move to the next one. So what are the components of a systematic process? So basically at a very high level, the components are data, signals, model, and optimal portfolio. So I'll dive into each of these uh, and explain what that means. So first look at data. So, so like making the investment decisions, you need to rely on data. Different kinds of data we have available are market data. So these are things like prices, volumes, FX rates, interest rates. And then we have economic data, which covers economic factors like unemployment, inflation, GDP growth. Then we have a class of data called fundamental data. So this is about what are the earnings and the balance sheet of the various companies, what's happening with them. And then we have corporate actions, which are dividends, mergers and acquisition. And then things about the industry, like who are the competitors of a company? What does the supply chain look like? What are the constraints on the supply chain? Things like that. So these are very typical common data sets that are used even in the fundamental analysis of the companies. And they also feed into the systematic process. But in the systematic process, we also tap into a lot of alternative data. So it's data is like satellite images, shipping information, shipping as in how the supply chain is operating. Where are the ships actually located in the sea? How quickly they'll get from this source to the destination. Those kind of data sets become more and more commonly used in the systematic process. You are able to tap into a wide variety of data sets to make your judgment on a particular asset. So you collect all this data, then you create something called a signal out of it. So what is a signal? Signal is a quantified insight from data. It's a number that you associate with an asset, which is based on data, which is your insight into what's going on on that asset. So what are the steps in there? You prepare and clean the data. You remove noise. A lot of these data sets, especially the alternative data sets, are patchy. They're not, you don't have coverage, or you don't have, you will have missing data points, or you'll have garbage data. So you need to clean and remove those data points. And then you standardize a value, and we'll watch out for look-ahead bias. I'll talk about look-ahead bias in a second, but let's give you an example. So I'll give you an example of, it's a very crude example, very simplistic example, but hopefully that'll help you understand what I'm talking about. So imagine we are trying to build a model for ice cream companies. We want to predict how a particular ice cream company stock is going to do. So we want to look at, like, one of the factors driving their returns would be how uh, how many ice creams they sell. So we want to predict that. We want to see, okay, if the ice cream sales rise, that means the company stock is going to do better. But how do you then predict ice cream sales? You will say, okay, let's look at weather. Let's look at temperature. When it's hotter, people tend to eat more ice cream. That means the company will sell more ice creams. So let's use weather data to predict ice cream sales, which in turn will affect their stock. Okay, so again, just this is a very crude, simplistic example, not very real world, but hopefully it'll help you understand this concept. So what do you do? So you collect weather data, you collect weather temperatures across different cities. Then you clean the data. There might be outliers, there might be missing data, so you take care of that. Then you standardize the value. Standardize the value, like you have weather in in one town, which is let's say 25 degrees Celsius. In another town, it's 35 degrees Celsius. You just can't compare the two. You need to look at the relative temperature so that you can determine whether it's relatively hot or not. So you look at, let's say, seasonal data, you look at past years data, you come up with an average temperature and you see whether that day's temperature is higher than the average or lower than the average. And that's how you standardize the value. And then using that, you can convert that temperature into a score, which is the signal, which is that if the temperature is higher than the long-term average, it's likely that people are going to consume more ice cream. And that means it's going to eventually reflect in the stock performance. Now, this is a long shot. This is, I understand, like just by looking at temperature, looking at this and the stock performance, there are many other factors. That will come when we go to the model, where how we combine multiple factors to build a comprehensive view. But for now, just imagine that you're looking at one data point, one source of data, which is this temperature, and you're trying to build some kind of predictive model on that data point, linking it to the stock price or stock returns. Okay, now let's talk about this look ahead bias. So during all this modeling, we are looking at past data, we are looking at historical data, and then we're trying to test our model. So one part of this process is that, does it actually predict the stock returns? When you're working with historical data, it's very important to remember that when you're using that data, you should not be using data that you wouldn't have known at that point in time if you're making a decision. So suppose you're making a decision on the 1st of January, you should only incorporate data points you would have known as of that point. You cannot incorporate information that came out later, because you getting the advantage of some information that you wouldn't have had in that point. So for example, like a lot of economic indicators, they are lagged. They come out a few weeks after the period, like after the quarter or after the year. And if you already incorporate that in your model as you knew them in the prior period, then you got the look ahead bias. You're incorporating information that you wouldn't have had. So it's very important when you're using this data to avoid that. Okay, so now this picture at the bottom is something is a test of a signal, whether that signal is going to be successful or not. And there are 4 tests that are applied to the signal. Sensibility. First one, sensibility. Why should the signal predict returns? So if you think about a temperature example and the ice cream sales, there is a very sensible reason why temperatures and the consumption of ice cream would drive the stock performance. So there is a sensibility factor there. Next factor is predictive ability. Does the signal predict the return historically? So this is where like I was saying, you do a historical analysis, you look at the data, you look at whether it's actually predicting the returns or not. Now, it might turn out that temperature is and ice cream sales aren't really predictive. Maybe that's what you observe. So you'll discard that signal, you'll discard that data point, you look for something else. Then consistency. Next factor is consistency. Does the signal work in variety of economic or market environments? Is it resilient to changes over time? So that's where again historical analysis becomes important. You want to be able to test the signal across a long time period. Typically we do something like 15 to 20 year back test. backtest being looking at the performance over historical periods to make sure that it works under various conditions. And then last one is additivity. Is this a new insight? Now, this is where, again, like I was saying, the signal that like looking at temperature is only sort of a very narrowly scoped viewpoint of just one data set, but we want to collect a lot of different insights and build a holistic view before we make an investment decision. We won't base our investment decision purely on this one data point. So additivity is where you look at all the things you have, all the different data and signals you've made, and whether this new signal that you're building is actually additive. Is it like a duplicate? Is it not? Is it overlapping with other signals? So combining these four, if you have all these factors check the box, then you have a successful signal. Okay, so now you have one signal which works, but like how do you turn it into an actual trade, into an actual execution on your portfolio? This is where the next step comes in, which is a model. So model is a collection of multiple signals that encapsulate different investment insights. So again, coming back to the temperature example, like that was one factor, temperature and ice cream sales. But like, what are the other factors that drive? Maybe the cost of raw products. Like you want to build a signal on cost of raw products. If raw products become more expensive, the margins are squeezed, and that means there's less profitability and the stock price is not going to be so great. So that's another data point. Then you look at number of competitors. Let's say there's some more competitors trying to sell ice cream in the market. That's again going to hit profitability. So you try to collect all these different kind of insights and build a collective viewpoint of on what's going to happen. Typically, there are three different categories of these viewpoints, and they have different information horizon. Fundamental value are longer lived. So these are like intrinsic to the company in terms of its business, whether it's what kind of investments made, what kind of prospect it has. The second category of insights are economic environment, things around what's happening in the economy, interest rates, employment, things like that. And then finally, a market sentiment, which is very short-lived, which is about on a day-to-day basis, there might be some news, some factor that's driving the market returns. It might not be totally connected to that specific stock, it's just driving the overall market. So all these factors come together. You want to, again, put it together in a way that gives you a holistic view of that particular company. And then from there, the next step is this optimal portfolio. This is the most interesting piece, and apologies, this equation might seem a bit daunting to begin with, but this is sort of the core of this process, the systematic process. So what do we have here? We're trying to construct an optimal portfolio. U is the utility function, which is what we're trying to maximize. What you're trying to maximize, there are three factors here. The first term here is the alpha term. Second term is the risk term, and the third is the transaction cost term. So alpha is our forecast returns, which is what you put together in a model. You're trying to put together different signals, different data and different signals into your prediction of what you expect from that asset. So you times the holding vector. So you multiply your expected returns with the holding vector. So this gives you an overall portfolio expected return. So this is what you want to maximize. But at the same time, you just want to make bets without looking at the risk. So the second term is the risk factor. Here, the sigma is a risk aversion parameter. This is sort of a parameter that portfolio managers can tweak. If they want to make the portfolio more risky, they can reduce the risk aversion, or if they do not want risk, they can increase the risk aversion parameter. And here, what we're trying to say is, again, holdings times a vector of forecasted risk, which is, again, you need to build a forecast for your risk as well, which I didn't talk about. I won't have the time today to do that, but basically this term is what you're trying to calculate a risk of each holding that you're going to put in your portfolio. And then you have the transaction cost. So markets are not frictionless. In order to trade in the market, there's a cost involved. This cost is not just your so to say the brokerage cost of making the transaction. There are other costs involved in terms of market impact. By making those trades, you actually move the market. So this is the third term is a prediction of your transaction cost. So all this together, you're trying to maximize your return subject to the risk and transaction cost. And this goes into an optimal optimizer, so to say. So this is where the AI and machine learning part comes in. You're trying to feed all this data into a machine so that can spit out and give you what is the optimal portfolio that will give you maximum returns subject to lowest risk and lowest transaction cost. So this is again sort of the cornerstone of this whole process. You feed in all this data into signals, combine them into models, and then build a portfolio out of that. So now what's kind of coming to the crux of the talk here? What is data and AI? How is it getting used here? So active investment is a zero-sum game. Someone's return, like you make, is at the expense of someone else in the market, and it's a highly competitive market. So how do you gain an edge? So edge I see coming from three sources, three ways in which you can build a competitive edge. You have access to data that no one else has, or you have it before anyone else does. So again, I'm not talking about insider information here. I'm talking about information that no one else has thought of using. Let's say for instance, this ice cream and the temperature. It's a very um, it's a very obvious linkage. But if you're creative, if you expand your horizon, you think about what are the other factors, what are the other things. If you need to get really creative, you can find data sets that can help predict the stock movement. We'll look at a few examples later on. So it's like about getting creative, finding sources of information that you can incorporate into your trading. It's also about maybe getting it before anyone else does. So those of you who have been familiar with the financial markets, there was some controversy where some exchanges were actually sharing information with certain hedge funds ahead of time, ahead of general release of the information. So those hedge funds had access to information before anyone else did, and they were trading on that basis, and they were basically profiting at the expense of other market participants. So again, I'm not talking about sort of these sort of illegal or unethical activities, but they are still sources where you are able to access that information faster, which again comes to the third point, which is process data in ways no one else can. Here, I'm talking about techniques that are big data techniques, or techniques that are applying very advanced machine learning that are very hard to get right. So if you have those capabilities, you are able to either process large amounts of data before anyone else can do it, or you're able to process data in ways that are very hard for anyone else to replicate. Again, we look at a few examples very shortly. So yeah, so examples. Um, First example is around natural language processing of news and reports. So there's a huge amount of data getting generated, huge amounts of news and reports that are published every day. Humanly, it's not possible to keep track of everything, make sense of it. So we can use machine there. You can use NLP analysis to run on those news and reports and extract the key insights. So this is an example of applying advanced machine learning to get information that no one else is able to garner. Next example is voice to text transcripts of earning calls. So like companies usually hold quarterly calls when they talk about their earnings and their prospects, future prospects. This is it's a phone conversation, so to speak. But if you're able to feed that into voice text engine, which is extracting the text from that audio, and then you can feed it into your NLP analysis, you can derive those insights very quickly compared to the market participants. Then the third example is actually one of the creative ways of using satellite images. So where you can use satellite images of parking lots of big box retail stores like Walmart and Target and others. And you can look at those satellite image, process those image, count the number of cars you see in the parking lot, and use that as a factor to see how many people are visiting those stores, and kind of carry on from there in terms of how much sales they're going to make. Again, a very tenuous kind of link between that data point and the company's performance, but it's just another data point. You're trying to get a very holistic view on that company. And lastly, Glassdoor employee reviews. So Glassdoor, if you're aware, is a social media, so to speak, website where employees of the various organization leave reviews about their workplace, about the management team, about their sort of experience working at that company. And here the connection is that if we have unsatisfied employees, will reflect in company's performance. So how you can, if you can look at those reviews, see how many are positive sentiment, negative sentiment, you can get some sense of how the company is going to be doing overall. So these are some of the examples that I can share. Again, like you're saying, this field is very competitive. So there's a lot of work that goes on that BlackRock doesn't want to disclose because it kind of gives away their competitive edge. So at time, I like to end by sort of the first thing I was saying, that humans make mistakes, are slow, but they're very creative. Computers are precise and very quick, but they're stupid. Success is when we can use right elements of both. With that, that's the topic I had to cover. It was quite a fast look at a high level look at the systematic investment process. Hopefully, gives you some more information in this area.
So, Manvendra, you are done with your talk, no?
Yeah. Yes.
Yes. So now we are open to questions. You can either use the chat box to raise questions or raise your hand electronically and then raise your question. Maybe I'll kickstart the discussion, Manvendra.
Mm-hmm.
In the meantime, others can collect their thoughts and put in the chat box or um, raise the questions. You mentioned about the use of satellite images. Now,
Mm-hmm.
this is becoming increasingly popular even in economics,
Mm-hmm.
wherein data is available with lag. So this may be one way of finding that out. And then the other thing is that micro level data, district level data, etc., are not collated, collected properly, and all that. So my question is that are there agencies which give out this data? Is it a price data? Or how does it work? The kind of data that you're looking for.
Yeah. So in the financial marketplace, there are lots of established data vendors. Like there's Reuters, there's Bloomberg, there's many S&P, and there are many others who are who their business is selling data, gathering and selling data. So through those vendors, you can access some of this data. But again, like when the data is commonly available, the value of that data in terms of predicting for active investment is very little because everyone's using that data. So your edge comes by finding sources of data that are uncommon or harder to access. That's where like a lot of people at BlackRock, the researchers at BlackRock, are hunting for data. They kind of call themselves data hunters. They try and, like, let's say like satellite images, so they try and establish contact with some of these companies who have access to satellite images. They try and kind of see how we can tap into that information and get them to supply that to us, the raw images itself, and then from there we kind of do our own processing to turn it into those insights. So it is hard. The data is going to be uh, you'll need to find ways in which you can really get your hands on that data, and then also like turn it into that insight. Again, like the cleaning the data, removing the noise is very critical. So are you on mute,
Yeah.
Professor?
So, for example, when demonetization happened in India,
Mm-hmm.
the how do you look at the impact of demonetization on economic growth, those kind of things?
Mm-hmm.
Um, International Monetary Fund, they did one study where they looked at the nightlight data of
Yes.
different districts, and then from there you correlate with that with the growth, and then say, look, possibly there is a 2-3% shaving of the GDP that has happened, in that locality. That
Right.
kind of a conclusion they came to. I was wondering, where do they get that data from? When they want this do this kind of maybe priced or non-priced, or if you are familiar with that.
Yeah, I mean, if you asking me if I know specific vendors of the data?
Yeah, or vendors, or is it they're available publicly, or what is it? How do they use it?
Yeah, again, I personally, like, I'm not involved in that data collection space,
Okay,
so
okay.
I don't know the
Sure,
vendors
sure.
specifically. I can find out.
Sure. No, I just was curious about that. Yeah, now you
Yeah.
can take questions from others. Vivek has raised his hand. Maybe Vivek can start. There are some questions in the chat also. You feel free to take the way you want.
Okay, Vivek, go ahead.
Hey, hi. Hi, Mr. Gupta, Vivek Bajaj, PGP 2005 pass out. Um, so I run a company called Stockage, which has around 2.5 million users. It's a stock market data and analytics company.
Okay.
I wanted to understand the use case of AI and ML in one particular requirement. So
Mm-hmm.
what we are trying to do is we are trying to rate companies based on their potential performance.
Mm-hmm.
Just like we have something called credit ratings, we
Mm-hmm.
are trying to evaluate a way to rate companies for stock investing.
Mm-hmm.
Now, the problem which I'm facing is that most of the ratings involve historical data.
Mm-hmm.
And we all know that stock market is all about future, and we
Mm-hmm.
have to find out ways to predict the future performance of the company because that's what drives the current market price.
Yep.
Now, could I get some input from you with respect to use case of AI ML for predicting future growth or future potentials of the company using not just the financial data but also non-financial databases?
Mm-hmm. Mm-hmm. Yep. I mean, I can give you again a very, like, a very high level example. I mean, there's a lot of depth in this topic I won't be able to cover. But for example, like, you want to look at future prospects. So you look at, like, Porter's competitive model, right? You've got the competitive pressures on the company. So you look at the supply chain, you look at their competition, you look at all these factors around it. So you'll need to how do you turn those factors into, how do you identify sources of data that give you information on those factors? So
Mhm,
for Indian market, it might be a bit harder, but for the US market, I do know there's data sets available that can tell you things like, for each company, what are their competitors, what are their supply chain dependencies across. So you can actually build this, what is called a network of dependencies in the industry. You can identify the critical
mhm,
players using data. You can look at key personnel, so you can actually get information about who are the like executives at these companies, how well they're connected. Like, they're quite interesting data sets available in that space in the US. I'm not aware if we
mhm,
can get same kind of data for the Indian markets. But, like,
mhm,
basically the trick there is you need to source the data. You need to be able to turn that into quantitative insight. How do you turn, let's say, information that the company X has three other competitors, and then you kind of the relative size of those companies in that market. How do you turn that data into something that you can feed into a model that gives you that kind of score? Uh, it's
mhm.
not an easy thing. I mean, we can connect offline. I can share some more ideas with you. But again, like, the trick might be that it's just availability of data. How do you gather that? Did I
Sure.
answer your question,
So,
Vivek?
yeah, partially, but I definitely need to connect with you offline. So I'll take your connect from the team, and it's a
Mhm.
great opportunity to interact in these kind of forums with people like you.
So Vivek, this is Professor Ganesh. So what you can do is that just drop me an email. I'll connect you to Manvendra.
Certainly, sir. Thank you.
Sure. Vivek, I think I was not at the institute when you studied, but glad to meet you over like this. Hopefully, you can meet some other time.
It would be my pleasure, sir. Thank you.
Sure. Manvendra, go ahead. Anjali has
Yep.
raised her hand.
Anjali, go ahead.
Am I audible?
Yes.
Yeah, so actually, I had two questions. My first question was, so I read this very interesting article wherein in the retail markets, they were looking at heat maps of the various stores, the way it was arranged,
Hmm.
and then they were
Hmm.
trying to decide, what kind of products to sell and things like that. So do you all like use these kind of heat maps as well, when you're trying to decide what kind of investment do you all make? That was my first question. And second question is, India is more of a developing markets, and we see a lot of fintechs coming up. For example, Navi, and their main target segment is the low and the middle income group of people. And they say that they manage their risk by using technology, and that's how they, decide the interest rates and things like that. So in a country like India, wherein data is not that easy to get, especially for the low and middle income, do you think we should solely depend on technology, or is there something else that we should put an ideal look at as well? So, yeah.
Okay. All right. The first question in terms of heat maps. So um, I am aware that actually there are vendors of data who are able to give very rich information about how people move around inside malls or shopping areas and all. So they're able to track your physical movement based on your phone and your Wi-Fi connectivity. They're able to track your movement, how long you spend in different parts, and which direction you move in, as in which sequence you visit the stores or different parts of things. So there are data vendors who are able to give very, very like granular data on that. There is actually now a lot of, I mean, that's kind of very common trend now, is more and more shopping is moving online. So we're able to get very rich information also on things like Google searches. How often are people searching for, let's say, a product by name or product category? How often is it occurring? What are the trends there? And use that to make predictions. There are information about app downloads. You can get information which kind of app is getting downloaded, how frequently, and which geographical market or which geography it's getting downloaded. Those kind of information are also available. So yes, that information is getting harnessed. Does that answer your question? Okay. Second question is a bit harder. Again, personally, I'm not so well connected with the Indian fintech area, so I'm not sure exactly. Uh, Now, you're right in terms of the purely relying on machine to make those decisions around interest rate or whether lend to that person or not. Uh, there are again indirect indicators. I know in the US market, there are modeling credit score models around individuals which rely on information which is not directly linked to financial activity. So they kind of try and gather information on the individual around, let's say, employment and stability of employment. So they try and look at employment history through indirect means. That's where a bit of an ethical issue comes in, right? Like if you try to look at that individual, like they look at medical history or something, like if there are any medical issues, things like that. It starts edging on the ethical side of things, which again might be a totally different topic to talk about. But again, sorry, I'm not able to give you a more direct answer on that question.
That's all right. Thank you so much.
Manvendra, a couple of questions are there in the chat box if you want to take them.
Yeah, sorry, sir, I'm not able to see the chat. My Zoom client here.
Okay, I will read out this. So one question is from Rishi. I think he is PGP1. How do signals help us decide when to sell a stock?
Okay, so signals you basically are a quantitative score of your prediction, and generally they are like, if they're positive, that means you expect positive returns. If they're negative, you expect negative returns. So it's kind of like just the direction and the magnitude is something that helps you decide how strong the signal is, as in if the signal is strongly positive, it will be a higher positive number. If your outlook or your prediction is negative, it will be a bigger negative, like a smaller negative number. That's kind of the general I mean, the construction of the signal is designed to give you that kind of indicator.
Okay, so the next question, the name is not full here, so just says A. So what are the educational and work experience requirement to get into quantitative investment jobs? And how is the salary, and what is it also, is it more tech oriented or business oriented?
Right. Okay. So there are various avenues to kind of learn and kind of educational routes here. So definitely the degrees like MFE, Masters in Financial Engineering, or CFA is also useful, though CFA is less technical, so to speak. Like it's not very deep on the quantitative side. So you need to combine skills on multiple areas. You need to combine business and financial knowledge with your knowledge of mathematics and computer science. It's kind of crux of these three things together that come into this area. Um, so if you come from a computer science background, just learn about business and finance, and kind of pick up AI and ML courses. There are several courses you can take from uh, Coursera and other places. So kind of you can supplement your background if you have background in any of these three areas with the additional skills that you can take from these courses. Salary, again, it's very subjective. Again, I'm not too aware how much in the Indian market you're going to get, but it's a very sought out of field in the US and a very hot market right now. AI and ML is a very specialized field. Um, So if you're going deep in that area, PhD is certainly necessary. But as applying that field into specific business problems is something you can learn. I'm not aware if there are any courses who can help you with that. It's going to be more on the job learning. I think I covered everything that was asked in that question, Professor.
Well, there's one more question. Who executes quantitative analysis? Is it done entirely by data scientists or also by financial analysts?
Yeah, so ultimate decision is being the trading decision is being made by a person called portfolio manager. So they are the ones who are responsible to the clients in terms of delivering the returns on that portfolio. So the decision ultimately lies with them. They take in all these inputs from the model and take a judgment call. So it's not purely machine, it's human plus machine.